Hello, everyone, and welcome to a special mid-year outlook market signals. Jeff Bookbinder here. I am pleased to be joined by Lawrence Gillum and Jeffrey Roach. So, Jeff, you got an encore presentation after being on last week. We are thrilled to be able to bring you our just released, although actually, as we're recording this on July 7th, 2025, it has not been released yet. But by the time you see this or hear this, it will have been released. So Jeff Lawrence and I are going to walk through Midyear Outlook 2025, at least the economy, the stock market, and the bond market portions of that. Of course, there are other sections of the midyear that we will walk through next week. We'll have Christian and Adam on next week to talk through currencies, commodities, geopolitics, trade policy, all of that good stuff. But focusing on economy, stocks, bonds, for today. The report is called Pragmatic Optimism, Measured Expectations. Of course, the full year outlook was just called Pragmatic Optimism. So, generally speaking, I would say a fairly constructive view of the world, but certainly, the markets are pricing in a fairly optimistic view of the world. So, that's kind of a addition or my opening setup here before I go over to Jeff. Um, I would say, Jeff, uncertainty probably permeates throughout all three sections of the outlook. So I know you're going to weave a bit of that into your comments. So why don't you start and just walk through your outlook for the second half on the economy, and you just tell me when you want to move the slides.
Well, excellent, Jeff. Thanks. And the title here with Entering Uncharted Waters, very appropriate with the previous slide showing the cargo ships. By the way, just personal disclaimer here. I love seeing the port of Charleston. I love maritime activity. So I love those references. I love the themes that we did here with our mid-year outlook. So the uncharted waters really refers to some of the data distortions that we're experiencing in the last little bit. So you can go to the next slide here, Jeff, just showing you that we're here. We are mid-year. We had some volatility in Q1, especially in the month of March. We often have a lot of volatility in January, but March was unusual because businesses pulled forward a lot of their demand overseas before the so-called Liberation Day and the tariff implementation. So a lot of choppiness. And what I'm showing you here, showing you growth, the economic growth numbers, along with the data series from the Institute of Supply Management. That's what ISM stands for there. The composite index, basically saying, for those that are really trying to understand what's happening, where we're having potential regime changes, perhaps shifts in trajectories, especially this time, mid-year 2025, after new administration, trade policy still being implemented, a little bit of unknown uncertainty about how this is going to shake out in the end, really requires us as professional market watchers to make sure that we're looking at all kinds of data, not just the government data, but alternative data that augments some of the distortions we're seeing here. Either way you look at it, when you look at some of the data here, I'm showing with the line, the ISM, it's basically just showing you that we're poised for a downshift in economic activity from that breakneck speed we experienced in the years immediately following the pandemic. That's kind of the key takeaway. Now, granted, the choppiness, I think, is even more elevated with the uncertainty on trade and debt, and finally getting a little bit of clarity from the one big, beautiful bill act. But still, the uncertainty requires us to be really careful in looking through, our crystal ball here for the latter half of the year. But let's go to that next slide. So the key takeaway here is just growth is slowing down. The speed of the slowdown is yet to be determined. And because of that uncertainty, it really adds another level of complexity for the Fed. So this is where I'm showing you inflation numbers as well as the Fed funds upper bound target. And then in the shaded area, the forecast for the latter half of this year. because of the uncertainty, because of these gyrations in the data for the first half of the year, unknowns about trade policy, Fed is basically saying, hey, look, if tariff policy hadn't been the topic of the day since April, as Chair Powell said, we were a little bit surprised, I think, all of us, when he said we probably would have cut rates by now. I think the tariff uncertainty and the inflation impacts are causing the Fed to say we need to just wait and see before we preemptively act. Now, granted, one of the things that they can do here is they can say, well, if inflation doesn't reaccelerate too badly, I do expect a little bit of an uptick in the coming months. Hence, you see a little bit of an uptick in the shaded area. But the Fed could say inflation, yes, above our 2% target, but at least it's stabilizing. Therefore, we could cut rates a little bit, not a lot, still remain above the inflation rate, but because economic growth perhaps could slow faster than anticipated, the Fed will respond by that risk by lowering rates. So the next slide, I think, gives you another variable that is not talked about too much, but really, really important to think about. And that is it relates to not just demand for labor, but the supply of labor. So I'm showing you something from the Bureau of Labor Statistics. They give us that monthly non-farm payroll number that hits the headlines. We hear that all the time. Another report that the Bureau of Labor Statistics puts out that we don't hear quite as much is the job opening labor turnover survey. So what's going on underneath the surface? Who's quitting one job, going to another? What's the churn, if you will? That's from the worker side, willingness to quit and look for another job. From the business side, what's the hires rates look like? So I'm showing you hires rates, quits rates, and I'm basically trying to build the case. One of the unknown factors for 2025 that will create a little bit of uncertainty and a note of caution, yet not necessarily a red flag, more of a yellow flag. And that is this: we have businesses probably saying, well, we're not that eager to shed payrolls because we have to work really hard to find qualified workers. That was what 2022 and 23 and 24 were all about. But we're actually just seeing a slowdown in the growth of the labor force. So that's the supply side of the labor market. And so we're going to have, I think, a unique challenge the latter half of this year and going into the coming years, where we're going to talk more about the labor supply side of things. And that's certainly going to impact unemployment. So you might say, okay, so what's the so what of it all? The so what of it all is if labor force growth seems to slow down, you might actually see a slowdown in the demand for workers and really no sizable or material increase in the unemployment rate. That's the key takeaway here. That's the so what of the labor supply and labor demand part of things. So let's not be too surprised that the unemployment rate stays on the lower end than what we would expect in a quote unquote normal economic slowdown. All right, so next and final slide before I pass it back, and that is this. So we talked a little bit about Fed, labor market, growth. Well, a lot of this does hinge on where the administration can find ways to negotiate. And I think the key takeaway here is this. I think people are worried about recession. Certainly the conversation about recession was front and center just a few months ago. But we're basically at this point, we say if the effective tariff rate stays where it is now, maybe hovers in the mid to upper teens, yes, that's a headwind to growth, but it's not necessarily a material recessionary flag. So I think people were very nervous in the month of April, where perhaps we might say, okay, we're going to be dealing with an average effective tariff rate of the mid to upper 20s. Well, that could be recessionary. And I think at this point, as long as we can see it hovering in that mid to upper teens, I think we might be okay. Now, granted, I think, Jeff, you're going to talk a little bit about how markets are trading a lot of good news, pricing in a lot of optimism. And maybe part of that is what we just said here on what the average effective tariff rate ends up hovering around. So that's setting the stage for you and Lawrence, you talking bonds. That's the stage here. And take it away, Jeff. Back to you.
Well, Jeff, that was a prescient segue because literally as you were talking, we just got a tariff rate on South Africa of 30%. Earlier today, we got tariff rates above 20 for South Korea and Japan, right? Is it 25 for both?
Yeah.
I think that's right. So, I mean, you said it yourself, probably going above mid-teens. We've been operating on the assumption that would be mid-teens for some time now. This is, and markets are selling off on this news. This, it's a little harder to discount this right now as just negotiating and, you know, thinking to yourself, well, it's 25 now in Japan, it's going to go to 10. It's 25 now in South Korea, it's going to go to 10, right? Maybe that 10 baseline is, not going to be as easy to reach in some of these negotiations as the market thought. So market might be pricing a little too much optimism, which really fits in with our narrative here from the Midyear Outlook, which of course was written before we knew some of these new tariff rates. So we've titled this section Path to Upside Clouded with Uncertainty. Now, some of the uncertainty has abated, but clearly there's still some left. And clearly, trade policy has been a big reason why we've had a volatile first half, and it will probably continue to drive volatility in the second half, hopefully less so. The sectoral tariffs, so like semiconductors and pharmaceuticals, those haven't been announced yet, right? And those are really in addition to all of these country tariff rates. So the market is going to continue to battle against these headlines for some time. Now, there is an offset. The one big beautiful bill that Jeff mentioned, the stimulus from that bill, incentives for capital investment, some essentially tax rebates for consumers, right? That coming through is going to provide an offset to tariffs. Actually, the numbers are probably pretty similar when all the dust settles. But nonetheless, the market is going to have to fight through this. And so we think it's going to be another bumpy ride in the second half, but there is absolutely a path to upside from here, which I'll go through in a minute. So I'm showing here this study, what happens after you recover from corrections. So this lists a couple dozen corrections, not bear markets. So it's 10% to 20% drawdowns that stop before they go beyond 20. This latest sell-off stopped before it was down 20. This is the S&P 500 we're looking at here. When those recoveries happen, which was June 27th, where we fully recovered the correction losses, gains in the next 6 and 12 months are pretty attractive here, up 9.6% on average over the next 6 months post-recovery and up 16.2% over the next 12 months after recovery, and you're up almost every time. Now, when you're in recession or the market's really worried about recession, or you're in some sort of a crisis, like 2002, for example, sometimes those recoveries, have some bigger bumps than others. 2011 is another one, the Greek debt crisis and all of that, right? The pandemic certainly interrupted the recovery from the 2018, 2019 correction. But it really takes a recession or crisis to knock stocks off of this pattern. So this gives us a little bit of an upside bias for the second half. So if we're going to have a higher second half, we're going to need earnings growth to get there. Also going to need a little bit of help from Lawrence on the bond market, which we'll get to in a minute. But here's the expected earnings growth in the Mag 7, the biggest 7 tech companies, compared to the rest of the S&P 500. And you see here, the growth rate for the Mag 7 has been quite a bit bigger than that of the rest of the market. Now, a lot of folks were saying at the beginning of this year that that gap would close and that that would drive a rotation into value. Well, we have had some, good performance here and there for value, but certainly growth has led this rally off of the April lows. One of the big reasons why earnings growth from the Mag 7 was stronger than the market expected, 30% in Q1, probably going to be well north of 20 in Q2. And the rest of the market didn't really pick it up very much. And so we had, kind of low to mid single digits. The rest of the market hasn't really been able to get earnings growth going much faster than that. And so that was the makings of a growth rally, which we've seen. Our bias is that it continues, not certainly as much as it has in the last few months, but we still think it makes sense to lean a little bit into growth over value. And that Mag 7 drives earnings growth because of the spending and because of the productivity growth that the AI boom can drive. So this is one piece of the path to upside in the second half. It's AI and tech spending. So I mentioned up front that there's a lot of optimism priced in, and this chart shows that. There's a little bit of a silver lining here, though. If you take out the Mag 7 again, those stocks are quite a bit more expensive than the market. You see here, X Mag 7, the S&P 500 actually is trading at below 20 times. If you include the Mag 7, you're talking about almost 23 times. And we think that's really the high end of what this market can handle in terms of valuations. So while we still are leaning into growth right now, we think it makes sense to watch out for a valuation rotation, and we could potentially get some upside from the cheaper parts of the market as we get further into the second half. So when people say the market's overvalued, they're really more talking about tech and the growth names, because the rest of the market looks, frankly, probably more fair. Now, that valuation premium does make it harder to predict multiple expansion in the second half. So here's just a grid. We could call this a scenario analysis, I guess. The point here is you have to go from about 260 in S&P 500 earnings this year to 275 next year to get to over 6,000 on a fair value basis. So we're using 6,000 to 6,100, which is slightly below where the market's trading right now, as a fair value target range. So that's based on 22 times 275. But the odds of the bull case have been rising. We got the bill passed. There's a little more incentives frankly, for business investment than we anticipated when this bill was first coming together. So there's a little bit of an earnings boost there. And obviously there's uncertainty predicting where AI goes, but the investment in AI is pretty strong right now. And that should continue. We're just starting to see that investment bear fruit in terms of productivity. So consider maybe 280, 285 a bull case scenario. Maybe there's somewhere around a 30 to 40% chance of that scenario right now on earnings. If you put a 23 multiple on there, you get to 6,500 plus. So that's the path to a better environment in the second half than our base case would suggest. Now, here's my segue to Lawrence. Certainly another way to get to a better return on the equity market in the second half than maybe a 6,000 or 6,100 fair value would suggest is if we get lower rates. So, Lawrence, are we going to get lower rates in the second half?
That is going to depend on the economy, I think. So to keep that uncertainty theme going, it really is going to depend on how the economic story unfolds over the course of the next several months. I'll start with the takeaway is that at least initially, we think yields are likely going to trade around current levels, maybe even a little higher. So for our 10-year Treasury yield forecast for the end of the year, we've moved it up a little bit versus what we had to start the year. Coming into the year, given the amount of rate cuts we expected, given the shape of the yield curve, the demand for Treasury securities, et cetera, we thought maybe a 4% number on or 4% level on the 10-year Treasury yield was probably appropriate. given what's taken place in the first half of the year, though, with debt and deficit concerns, as well as a global repricing in the interest rate environment. Perhaps there's going to be some challenges to get below 4%. So our new target is 4 to 4.5%. So I don't know if that helps per se, Jeff, but I don't know that we're going to see 5% absent a reacceleration of inflationary pressures. So there's a silver lining in there, I guess, somewhere, that we probably think we're past the secular highs in rates, but that doesn't mean that we think rates are going to fall pretty meaningfully from current levels, absent any sort of economic slowdown that we think is perhaps maybe a low probability event, given what Jeff talked about earlier in the webinar. So I have fewer charts, more words. I don't know if that's a good thing or a bad thing, but if we can start with the first slide. So my section, I call it a Jekyll and Hyde bond market, because it is a tug of war right now between that economic data and the deficit spending. So we'll start with the Mr. Hyde part of the bond market. Mr. Hyde, as you remember from high school readings of the Dr. Jekyll and Mr. Hyde book there, the Mr. Hyde is the fearsome one. That's the evil monster. And what we're trying to explain here is, with that analogy, is that traditionally the fixed income markets tend to react positively to economic weakness. That's the Dr. Jekyll part, which we'll talk about in a second. The Mr. Hyde part, though, is the concerns about debt and deficit spending. So as we know, the President Trump just signed that One Big Beautiful Bill Act into law over the past weekend. Early estimates, I think, are expected to see deficits increase by about 3.5 trillion over a 10-year horizon. So I guess in a best case scenario, that new bill does not add to deficit spending after you take into consideration the potential for tariff revenues. But it doesn't bend the curve lower as well for deficits. So we're still going to be dealing with pretty sizable deficits within the economy that the Treasury market, or the Treasury Department in particular, has to fill through Treasury issuance. So if you're running deficits in that $1.5–2 trillion number every year, that gap needs to be filled with something, and that something is Treasury securities. So when you start to issue that much debt, over an annual pace, we're tending to grow the deficit, or I'm sorry, the debt limit by about $1 trillion every 6 months or so. So that means a lot of new Treasury securities are coming to market on a regular basis. That just means there's going to be a lot more supply that needs to be taken down. At the same time, that the foreign investor, the foreign investors have other options again. So as a reminder, foreign investors make up about 30% of Treasury ownership, but long-term interest rates globally have really moved higher. Think about the UK gilts market, the Japanese government bond market, the German Bund market. So all these big foreign investors tend to be big investors in the US, or they had been anyway. It's because their home rates were relatively lower than ours. They've moved higher. So a lot of these investors really are just not incentivized to own Treasury securities on a go-forward basis. So you have, again, this supply-demand mismatch, aka the makings of a steeper curve through a higher term premium. And what we're showing here is the Treasury yield curve. This is the difference between the 2-year Treasury yield and the 10-year Treasury yield. And because those differences aren't historically wide, there's really no reason to own kind of longer maturity securities right now, in our view. So you have all this issuance, you have foreign investors stepping away, you have a curve that still isn't very steep by historical standards. So that could mean that these 10-year Treasury yields, 20-year Treasury yields, 30-year Treasury yields are going to stay higher than they otherwise would be, given the economic conditions. So we're in a scenario, we think, that's somewhat unlike what we would expect out of the bond market, given economic conditions, because of all the concerns about debt deficits and the supply-demand imbalance coming out of the Treasury market. So bottom line is, we do think that the 10-year Treasury yield is poised to be around current levels. We're at 4.4 right now. On July 7th, maybe we get into the 4.25s, 4% by the end of the year. But to get much lower than that number, we do think that we're going to have to see perhaps even an economic contraction. That said, we do still have the Dr. Jekyll part of the narrative. So this is the good part of the narrative. Bottom line, though, with the Treasury market, Treasury securities are ultimately a function of Fed fund rate expectations. So if you think about what the Fed is going to do over the course of not only 2025, but 2026 and outward, there is a lot of room for the Fed to cut rates, as Jeff mentioned earlier. So given current pricing, when we put this chart together, the market was only expecting a trough Fed funds rate of around 3.7%. The Fed has said that kind of neutral is around 2.5%. So if the Fed is right, if the economic data comes in perhaps worse than expected, the inflationary data comes in better than expected, that should allow the markets to price in more Fed rate cut expectations over the next couple of years. That should provide that price appreciation for bonds, which could push those those Treasury yields even lower than our forecast. So not all bad news. There are concerns out there for the debt deficit spending, supply demand imbalances, still a relatively flat curve. But ultimately, as the economy goes, so goes Treasury yields. So despite the fact that we're laden with historic amounts of debt, ultimately, if the economy does start to slow, or if there's a geopolitical event or an instance where the market needs to price in more Fed rate cuts than what we currently have, you could see some price appreciation out of the Treasury market. So more of the same we expect over the course of the next couple of quarters into 2026 in a trading range for the 10-year Treasury yield. But again, the silver lining is I don't know that we're going to see 5% again. And if we do, that could be a good number, a good level to add duration to portfolios.
Yes, sir. Thanks, Lawrence. Certainly the equity market has seemingly taken 5% off the table because we know in the past when the 10-year yield's gone to 5%, especially when it's gone there quickly, the equity market has thrown a tantrum, right? So, people are probably wondering why this stock market's done so well because we've still had the threat of tariffs. And, you could even argue that this bill in Washington was always expected to pass, right? And we still don't know what inflation is going to look like. So why is the market up? Well, clearly the market is discounting the risk of a bond market tantrum, and is kind of path of least resistance is to go higher. So when I compare stocks and bonds, though, I think, well, you just painted a picture of a bond market that's probably not going to be too much better than a coupon clipping kind of environment. And I just painted the picture of a stock market that might not be much better than that, right? So, that tells you maybe you don't have a strong preference for stocks and bonds. And then that fits with our neutral stance. So we're maintaining a neutral stance on equities and fixed income, and waiting for potentially, either an equity market dip to buy or potentially, one to sell if we keep going higher. So thanks for that, Lawrence. Appreciate you walking through that really high level. You can find the publication on LPL.com, our mid-year outlook. Thanks to you too, Jeff, for walking through your second half economic outlook. I guess, if uncertainty is kind of the theme, or maybe being measured, of course, from the title is sort of the theme, then that suggests that things could be, better or worse, right? There is there's some uncertain variables here, depending on how they play out. So, the economy is probably going to slow. Maybe that's not that uncertain, but certainly there's uncertainty that could potentially push stocks up or down, and could certainly drive bond yields maybe down. I think, Lawrence, you just basically alluded to it. Maybe the odds that we go below 4 are higher than the odds that we go to 5. But nonetheless, there's still uncertainty there. So have those bonds in your portfolios as a cushion against potential equity market volatility. Still getting some decent income. Still makes sense to kind of be balanced, we think, in line with your target, whatever that is. So any closing comments, gentlemen? You want to kind of leave the listeners with maybe one additional thought before we wrap? You,
Well,
Jeff.
Yeah, sure. So, at this point, I think it's fair to say key takeaway is you never want to have recession probabilities down to zero, but maybe we should say, at this point, recession probabilities are, say, in the 20% range, which historically, that's that's not a bad situation to be in. Now, granted, there are some fragilities, I think, is a key takeaway. Uncertainty will ultimately lead to some fragility. And I think that's why we want to have some note of caution. But certainly, this is not an environment where there won't be any opportunities either in the equity space or the bond space, fixed income space.
And Jeff, you talked about slowing economy. What's your updated GDP forecast for 2025? I know it's over one.
Right. I think we'll be closer to about a 1.7% growth, mostly in the latter half of the year. Q1 was negative because of imports. Q2 is going to be really a bounce back from the decline that we saw, particularly in March. But I think the real value is what business investment will do the latter half of the year. Hence, we'll be above the 1.5% range for the whole year as we anticipate a fairly nice clip in Q3 and Q4.
Very good. Yeah. So Lawrence and I, of course, gave our forecast, so we wanted to make sure you got a turn as well. So closing comment from you, Lawrence?
Yeah, I would just say that despite our view that interest rates are going to stay around current levels and not fall, there's still a lot of opportunities to harvest income in fixed income markets. So with yields in the treasury market around 4% and the corporate credit markets around 5%, preferreds, et cetera, you can still generate a portfolio yielding around 5.5% without taking a lot of interest rate risk or credit risk. So there's still an opportunity to own bonds, regardless, or despite the fact that we think yields aren't going to necessarily move significantly lower from current levels. Buy bonds, buy laddered portfolios, things where you can have some certainty about the maturity of your portfolio, and just clip coupons because it's a great coupon clipping environment.
Very good. And my closing remark will be that we still like financials and communication services at the sector level for the second half. Certainly, deregulation can help financials, and communication services is really turning out some solid earnings gains and that we think will continue in the second half. And actually, valuations are quite reasonable. Certainly, we think more reasonable than tech, which remains a little bit pricey in our view. There's digital media and communication services that people call tech, but it's a pretty diversified sector with different types of telecom companies and cable companies and other media companies. We think that's maybe a better mix for the second half rather than initiating longs in tech at this point. So comm services and financials are two favorite sectors for the second half. And I would also keep an eye on industrials because they really benefit from this bill. We'll see how they behave in the coming weeks, but that is certainly a sector to watch as well. So one more thanks to you, Jeff and Lawrence, for joining this week and helping me walk through the Midyear Outlook 2025, which is available for you now on LPL.com, hot off the press. So hopefully you enjoy it. Next week, I plan to bring Christian Kerr and Adam Turquist on, and we'll talk about the rest of the outlook because there's a number of different sections. So we'll talk currencies, commodities, and maybe a little geopolitics and other policy mixed in. So please join us for that. We will see you next week. Everybody have a great one. Hopefully you had a great July 4th holiday. We will see you next time. Take care.